Okay, welcome to another session by Mr. M.Patrick. Today we are going to look at depreciation of non-current assets. But before we proceed, remember to subscribe to the channel. It's very important. And you can also even click on the notification bell as well, so that when I upload the video, you'll be able to get the notification. Good. So just go direct to the point of the day, that we have to start to define depreciation. Start by the definition. Start with the definition. We start with the definition of the depreciation. And we can say in simple words that depreciation is the loss of value, is the loss of value, is the loss of value, is the loss of value of non-current assets, of non-current assets. Okay, I believe all of us, we know non-current assets. In the other video, while I was introducing the financial accounting, I said that the assets, they are categorized into two. We have the non-current assets, or you can call them fixed assets, and at the same time we have the current assets. We say the non-current assets, they are assets that the organization, the business, they bring into the firm of the business for the purpose to help them to generate income to the organization, but not for resale. And we intend these non-current assets to be in the business for a period of more than 1 year. Vis-a-vis the current assets, whereby they are being brought to the business for the purpose of trading activities. E.g., maybe the stock of the business, maybe you want to buy the stock to do the resale. But here, when we talk about the non-current assets, we are talking of the machineries that you are bringing to the business for the purpose to help you produce goods and services to be able to send to the market so that you can generate income. Good. So the non-current assets, as we know, they are categorized also into two. We have the tangible and intangible non-current assets. So the non-current assets, let me talk about it. Non-current assets, we say they are categorized into two. We have the tangible assets. The tangible, or you can feel them, you can touch, they have the touch. Then we have the intangible. Good. Intangible. Now, when we are now on depreciation, when the tangible assets lose value, it's when we say now that we come in with the word depreciation. So when the machinery in the farm, they are going to lose value after maybe a certain period of time, I will call that one depreciation. Maybe let's say we have you buy the vehicle in the business that will help you to do the distribution and also say the purpose of the machine, the vehicle, or the machinery that are used to produce goods. When you use for a certain period, let's say span of 5 years, the value that you bought with, it will not be the same when it comes like 5 years. When you buy the vehicle today with 5 million and it serves you for maybe 3 years, you can maybe dispose it at 3 million. So you see, that is now we call depreciation. But the intangible assets, like the goodwill, the example for intangible asset that doesn't have the touch value, or they cannot feel them. We give the example of the goodwill. Yeah. When they lose value, we call it now the amortization. We call it amortization. It's not the same as for the tangible asset. This one we call it amortization. Good. So this one we say the assets that are done what? They are amortized. So that is for a case of intangible assets. So for today, we are purposely looking for the intangible assets, the machinery, all name them. So we are going to focus today on the tangible assets. Then another video, I will come and show you how we are going to look into the intangible assets and how to calculate the amortization for the goodwill and others, name them. Good. Now, so that means it is mandatory. Actually, it's not that we just wake up and say you want to calculate the depreciation in the farm, but it's mandatory for every farm to come up with the provision of depreciation, because at the end of the trading period, we have to come up with the financial position of the business, of the farm, or you can call it the balance sheet, where we have to know the assets and the liabilities. So to come up here, it is legal requirement for us to come up with something called provision of depreciation, whereby by this we are able to calculate the depreciation at a certain period of time. Then we less from the cost that has been we bought the machine with, so that we can deduct it, or we can capture that in our financial position at the end of the year. So that one you'll also see how we'll do it. Good. So before we venture even into the practical part, there are some aspects which I would like us to get into. We know them before we do that. So one, what might cause the depreciation? Let us look into the causes of depreciation first. Causes of depreciation. So up to where we are now, you can find two questions in an exam. One, define depreciation. Two, give the causes of depreciation. So pay attention as we go. You can note that question down. Good. So the causes of depreciation. One, we have wear and tear. Wear and tear. This just means that when the longer you use the machinery or the assets, the tangible assets, it will lose value. It's going to lose value. As we said, maybe you have the vehicle and it's going to serve you. The moment you have just started to use it, maybe to supply your goods or to go for the to get the goods into the farm, remember, the moment you are using it from time to time, it's losing value. So it will undergo also what? Wear and tear. Just the same as to the machinery maybe used in the production. You know, they are running from time to time. That means they are undergoing wear and tear. So that is one of the factor of the cause can result in depreciation. We have another one, we call it obsolescence. Obsolescence. Consider the spelling. Cannot that one. Obsolescence for this case is when just an asset where it loses value immediately. Maybe you introduce a new technology. A new technology comes in place. It means that the one that was in place, it will become obsolete. Just take an example. E.g., initially we had typewriters. Here you can remember initially in the car, before the computer were introduced in place, the typewriters were in place, whereby they were used to do what? To type and to do anything to do with the paper. But immediately the computer were introduced, or the technology was improved. When the computer now came in, the typewriters became obsolete. Now they were no more used by the farms. So that's another factor that can result in the loss of value of the non-current asset. We have another one, you can say another factor, the passage of time. Passage of time is another factor. Passage of time is another factor that can result in depreciation. So the value of an asset previous, maybe let's say last year, this year, it was costing maybe the way I said 5 million. When it will come to after another 5 years, you realize that there's passage of time. There's a time you have used that machinery or that an asset. So it means there's that passage of time, meaning it has undergone a depreciation, and there is loss of what? There is loss of there's loss of value. There's loss of value. Good. We have another factor that can result in depreciation that we call it inadequacy. 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 Good. Inadequacy. For this case, you know that the assets you are using, maybe they're not coping with the demand or the existing demand of the business. You know, maybe the asset you are using in the organization at the moment, it doesn't produce the required units maybe the firm is in need. This comes in place when the demand goes high. Maybe initially you are producing 100 units in a farm, but when the demand in the market is high, the farm is needed to produce maybe 1,000 units. So it means you had maybe a small machine that was producing what? It was producing just those 100 units. But because of the demand in the market, because of the economy, as the demand has gone up, so it means that you'll do what? You'll have to, the current asset in the business has lost value, meaning you'll now do what? You'll have to get a machine that will be able to produce 1,000 units. So that is what we call inadequacy. So here it's just a matter of demand. Demand. For those who have attended my class of demand and supply, that is microeconomics, you can understand this more in regards to the demand or under equilibrium, all that. So the opposite of the inadequacy, you can say the superfluity, the super, or where we call the surplus. In economics, we call it surplus. But here, in depreciation, let me let you know that it's called superfluity, from the word surplus. Good. Here is just opposite of the other one. Remember, in adequacy, we were saying the demand is high. So we need to get the machine that we can produce what? We can produce 1,000 units compared to what we are producing 100 units. But now in superfluity, it means that now the demand has gone down. The demand has gone down, meaning that we need now to get the machine. If we are producing in the organization 1,000 units with the bigger machines, and now in the market, the demand has gone down, meaning there is no need for us to have that bigger machine. We just have to go and purchase a machine that can produce those required units in the market and be able to supply those ones. So meaning the one that now the business will not be there. It means it will have lost value and we'll have to dispose it. We'll have to dispose it. Good. Another factor we can say maybe the physical factors. Physical factors. Physical factors. Which one this one factors that you cannot run away from. This one you cannot run away from. E.g. the flood. Say the fire. Name them. Yes, this one we have said the demand goes down. Demand low. Let me just say demand low so that you can note something down. Now the physical factors for this case I've said. Now maybe you have something like rain, fire, flood. Let me use the example. Let's say the rain. You just park your vehicle outside. You have not created a shed for it, or from time to time, it's the rain is just maybe on it on daily, maybe after month, after another one. You'll realize that that vehicle will lose value. It will undergo what we have said here, even wear and tear. And at the end of the day, it will not cost the value that maybe you bought it at the beginning of the original cost. You'll have to dispose it with another amount. Good. Even floods can result in depreciation. Even floods can result in the depreciation. Good. So you will realize we have so many factors that can cause depreciation. We have even accidents. When you go an accident, it will result in depreciation. The value of that asset will do what? Will go down. Will go down. Another factor you can say even fall in market price. Market price, the way you can relate to what we have talked about here, the inadequacy and the superfluity, which just on that line. Good. So those are the causes. So this is another question expect in an exam scenario, or if not in an exam scenario, you are in a farm. Just know these are factors which you have to know, to be aware of, just in case you can protect so that you can remain on top. Good. So after the causes of factors that result in that, we have to now go direct to the part that I think it is very interested. But before we go to the part that is interested for the day, I have to know now, after we have undergone depreciation, how do we dispose this now? How are you going to dispose this assets? That is another question. Disposal of assets. So you can just write here disposal of assets before I embark on what was intended even more today. Disposal of assets. How do we dispose this after we have encountered these factors and we have undergone depreciation? So how do we dispose this? How do we dispose the assets? One, we can dispose by doing what? Selling the assets. That is one. By doing what? Selling the assets. So we'll decide, now we have undergone this, so we'll have that to sell the asset. Asset we can also being written off. We can written off. Find other organization, they write off some of the assets written off. So here you realize that we can either, maybe because of the accident, so they are damaged, so we just do what? We write off the assets. Another one we can be scrapped or used in another means. So can scrapped, so whereby they can now be put in a scrapped form, so that they can be put in other means, so that it can be used for other purposes. So those are some of the how we can dispose the assets after they have undergone what? Depreciation. You can sell them, write off, or they can be scrapped. Good. So let's now go to the direct the topic that maybe I want you to pay more attention. One, we want now to look on the factors to consider when calculating depreciation. Factors that you have to consider at all times when we are calculating depreciation. I know at the end of this session, you are going to calculate depreciation of any non-current asset you have currently in your organization, or it is on the personal level. You can do the calculation for depreciation. So what are the factors are we going to consider? Factors, so that is another question you can get, or when you are calculating as an accountant, what are the factors you have to consider when calculating depreciation? If you are an accountant, what are the factors to consider when calculating depreciation. Good. This is another question. Must pay attention for the students. That's another question. So factors to consider when calculating depreciation. One, the cost of the asset. 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 When we are going to calculate the depreciation, here you have to quote the cost. What is the cost? Because in every question or in every practical session you are going to meet, first you will be told the cost of an asset, maybe that is 20,000. Yeah, so you will be able to quote the cost of the asset. So not that one, the cost of the asset. So you have to know this. If you are purchasing the book value of the asset at this initial period, we will compare it to another factor that I'm going to show you, that is called estimated or the estimated scrap value. What are we going to sell after a certain period of time? So first thing you have to know what? The cost of the asset. The cost of the asset. So another factor you have to know, the estimated useful life. The estimated useful life. Estimated useful life. Now that we don't know, we estimate, we are making assumptions that this vehicle, I'm going to use it maybe for 5 years. We are making assumptions because we are not sure of it. That's why we are using the word what? Estimated. So the estimated, the useful life. Here we assume just the time we expect to be what? To be with the asset in the organization or in personal level possession. Good. So here we use the word estimated for because we are not sure. We are just making assumption that I might use this vehicle for 5 years and then I do what? I dispose it by selling and get another one. Good. So you have to know that in every question you will be given estimated life of the asset. You'll be told the asset bought at maybe 20,000 is expected to be used for 5 years. Expected to be used for 5 years. So you have to note that. That is another factor. Another factor we have to know also the estimated scrap value. Estimated scrap value. Estimated scrap value. What is scrap value? Scrap value. Scrap value is just the amount of money or the amount that you are going to attach to this asset after it has been used for that certain period of time and it has undergone the depreciation. So we expect it to be sold at this amount that we are going to quote. This amount. So you'll say maybe after 5 years, I expect to sell my vehicle at 1 million. Maybe you bought it initial cost, this one now, initial cost was 5 million. Then you expected to use the vehicle for 5 years. Then after that, you expected to sell at maybe 3 million. So the 3 million is what we call estimated scrap value. Estimated scrap value. Estimated scrap value. Good. Then another factor you have to consider also, we have part 4, we have to know the methods of depreciation. Methods of calculating depreciation. Methods of calculating depreciation. Now, we have so many methods of calculating depreciation, but in this session of today, I will focus on 2 methods. I'm going to focus on 2 methods. One is what we call the straight line method. The straight line method. So the one we are going to focus on 2. We are going to focus on straight line method. Straight line method. Straight line method. Then 2, we are going to focus on another method called reducing balance. Reducing balance method. Reducing balance method. There are many factors, there are many methods, almost 10 of them. But for today, I want to focus on straight line method and reducing balance method so that we can use even these 2 methods to calculate our depreciation wherever we are. Good. Then, by that, let's go direct to the straight line method. The straight line method. Other people can call it, in other books you'll find being called the fixed percentage. The fixed percentage method. Yeah. Fixed installment method. All of them, they just mean the same thing. Good. So here, so our part A, let's just focus now on straight line method. So straight line method, as we are going to look into straight line method, remember the factors I started with, this one. First, as we are going to calculate using depreciation using the straight line method, we are going to make sure we know the cost of that asset. We know the estimated useful life. Also, we know the estimated scrap value. So that is it. Now, under straight line method is very easy. Here, one, you have to know the formula for the straight line method. Is very simple. Now, when you are using the straight line method, to calculate depreciation, you'll say depreciation is equals to cost you minus the estimated scrap value. estimated scrap value. Estimated scrap value. Then you divide by what? Estimated scrap value. Then you divide by estimated useful life. Estimated useful life. Estimated useful life. Good. So you can see the reason why I started with the factors. Cost. You can see I say the cost of the asset. So you'll, while using the straight line method, you will do what? You will use the cost. You have to know the cost. The scrap value, we have said the scrap value, this is the amount of money we expect to sell the asset after a certain period of time. Then estimated useful life, maybe the estimate we take it like the machinery or the asset, we are going to use it maybe for 10 years, for 20 years. So that is the estimated. We are not sure. That's why we are calling it estimated useful life. Good. So you'll get an equation that maybe a machinery in a farm, let's say you can get a question in this regards to this. A machinery in a farm was bought at a cost of, let's use this one, machinery was bought at a cost of 20,000. Good. The estimated useful life, we can be told estimated useful life, we useful life for the machinery to be used in the farm in 5 years. Then estimated, after it has been used in the farm, we have been told in a question that it is estimated to be sold at amount after all those period at around maybe 10,000. So estimated scrap value, we have been told it will be sold at 10,000. Then you are told using straight line method, calculate the depreciation of the machine. Using straight line method, calculate depreciation. Calculate depreciation. Now with the formula, just easy. Now we know the factors that we can enable us to get the depreciation. One, you'll get you'll say depreciation equals to the cost. Initial cost was 20,000. Then estimated scrap value, we have been told it will be 10,000. Then you divide by estimated useful life. We have been told it will be used for 5 years. Estimated to be used at 5 years. So you divide by 5. Meaning here it will be what? 20,000 divided by 10,000. You'll get what? 10,000. 10,000 you divide by 5. So meaning here 1, here 2. Here 2. 2,000. So meaning the depreciation after 5 years of that machinery will be what? If we are in Kenyan shillings, it will be 2,000. That is if they have not given in percentage form. But what if they have given you in percentage form? But they want you to use what? The straight line method. Now, if they have told you, just in case you'll get a question as well of percentage, don't get worried. It's just the same thing. Now, here you'll be told maybe 10% of the as a depreciation rate. You'll get another question now in percentage form. You'll be told 10% as an depreciation rate. 10% as depreciation rate. You see? Using the straight line method, and as the cost of an asset that was purchased in the farm was 20,000 Kenyan shilling. 20,000. What is the using now the straight line method? Calculate the depreciation after a period, estimated period of 5 years. After estimated or useful period of 5 years. Good. So here it's very easy. What you'll do now, because we are under using the formula straight line method, so the percentage, the rate, the depreciation rate percentage, it will remain constant all through. It will run across the first year, second year, third year, fourth year, fifth year. It will be just 10% because we are under straight line method. So you'll say first year, 10 over 100, you multiply by 20,000. So the depreciation of that year was what? Was 2,000. Depreciation of that year was 2,000. The same, the second year, the same, 10,000. 10 over that, divided by 20,000. Depreciation of the second year was also 2,000. So you'll do that until 5 years elapse. 5 years elapse. 5 years elapse. Good. So it is just going to apply this each year. That rate will apply at every year, and that is how we do under straight line method. If you have not understood straight line method, which is very important, nice method to calculate depreciation, where you can get one, you are not been given in percentage form, you do the way I have given the formula, cost minus estimated escape value, you divide by estimated useful life, you'll get the depreciation. Good. Then another one, if you have been given a percentage form, just make sure that it will apply in all years. So you'll have just applying in all years. Now I want to do another one which is very interesting, relating to this one of the percentage form. Now you realize the one we are going to do, the reducing balance, the book value will keep on, will not go with the 20,000. The way we are going with the 20,000. Here you can see it remain 20,000, remain constant. But in reducing balance, we are going to be reducing the original cost. If you get the first year 2,000, you less into 20,000, you calculate the depreciation of next year with what? 18,000. Good. So let's do the reducing balance method. Reducing balance method. Under reducing balance method, very easy also. So we are on method 2. We are still on depreciation. So reducing balance method. Reducing balance method. Good. Reducing balance method here is when the depreciable rate reduces each year. So unlike to the straight line method, you realize that we are just going with the same amount throughout the years. But here we are going to reduce the original amount from year to another year. Good. So the rate also the rate of depreciation here is not applied on the same cost. That is why I'm saying we are going to reduce the cost of the machinery from one year to another. So the rate of depreciation, yes, we'll have that rate of depreciation maybe 10%. So the way we are going to apply it to the second year is not the cost the amount we applied it on the first year. Good. So we'll understand this when we do maybe a practical. Good. So we'll be told affirm the depreciable rate, the depreciation rate, you can be told the depreciation rate is at 10%. Let us just use the one we used before, the 10%. Then the machine was bought at a cost of 20,000 Kenyan shillings, depending on the country you are watching this from. Then we have been told we expect it to be used after 5 years. The estimated period of 5 years. Estimated period of 5 years. Now, using the reducing balance method, calculate depreciation of the machinery. Using the reducing balance method, calculate the depreciation of the machinery. Good. Now here, it's very easy. So you'll say how now to calculate depreciation. We'll calculate depreciation now here. So I will say the first year, because it's 5 years. So I will just say first year. It will be equals to 10%. That is 10% rate. You multiply by the cost, which is 20,000. 20,000. That is the first one. So the depreciation that the machine lose value was how much in the first year? It will be what? 2,000. 2,000. It will be 2,000. Now, going to the next value, what is the book value now? The next value. So here the new book value here will be what? The original cost was 20,000. So you less now the depreciation of the first year, which was 2,000. So the book value in this case will be what? Will be 18,000. 18,000. 18,000. Use the currency depending from where you are. 18,000. Now going to calculate depreciation on the next year, I will do what? The second year now. Second year, the rate remain constant. It will be 10% depreciation rate. Multiply now by 18,000. 18,000. So I will calculate that. I will have my depreciation for that second year was what? 1,800. 1,800. 1,800. 1,800. Now, what is the book value? The new book value. The new book value, so it will be the new book value, so that we can go to the third year. It will be what? It will be 18,000. 18,000, we minus 1,800. 18,000 minus 1,800. We have 16,000. 16,200. 16,200. So this is the value, the book value. This is the new book value. Book value. We are going with it to the next year. So it will be third year. Third year depreciation will be 10% of 16,200. So I will have 1620. 1620 was the depreciation for the third year. Depreciation for the third year. So by that, I'll come also calculate the new book value. So it will be 16,200 minus 1620. 16,200. 16,200 minus 1620. 1620. What do I have? I'll have 14,580. 14,580. That is the new book value now. This is the new book value, but the depreciation cost now for the fourth year will be what? 10% of that. 10% of 14,580. 10% of 14,580. It will be what? This goes with this, this goes with this, so I will remain with the 1458. 1458. 1458. 1458. So you'll also come get the new book value. New book value will be what? 14,580. You minus 1458. Minus 1458. I'll have 13,122. 13,122. Now the fifth year will be what? 10,000, 10 over 100 multiplied by 1322. What was the depreciation of that year? Was 13,200. It was 1,000. Good. So that was 1,302. 22.2 shillings cents. So the last new book value of that machine after 5 years will be what? Will be now, you'll get now 13.22. You minus 13.22.2. You'll get what? 13.22 minus 13.22.2. So we'll have 11,000. So the new book value after 5 years was 11,899.8. 11,899.8. So you see, it keeps changing. You see the original, in the straight line method, the cost was remaining constant. But here it kept reducing until the last year. So that is how the reducing balance method apply. It applies that way. You keep on reducing the cost as you calculate the depreciation for each year. Good. So this is how we do the two methods. Very easy. Just a matter of just following the steps, and you are good. The moment you know the factors, you know the cost, you know the estimated scrap value, you know the rate. If they have mentioned the rate, this is how it applies. Then at the end of the day, you can get the accumulated depreciation of those 5 years, where you add the all from the first year, second year, third year, fifth year. You add them, you'll get now the accumulated depreciation, where you'll add 2,000 plus 1,800 plus 1,620 plus 1,458 plus what? Plus 13.22.2. If you add those, we call them accumulated depreciation. That is now, we will see how we are going to treat it in our next part, which we call it now treating depreciation in, how we treat depreciation in accounting. How do we account for depreciation? Because we said at the end of the day, we are doing depreciation purposely so that we can do what? We can be able to show it in the financial position, or the balance sheet. Good. Now, after calculating that, after we have done this, the next part we will look into the, now what? We are coming to accounting treatment in depreciation. But before that, I have to mention some of the objectives that has made us to calculate depreciation. What are the objectives? What are the purpose of us doing all this calculation? The purpose. Before we look into the accounting, the treating accounting of the depreciation, you have to know what are the purpose. What made us, or why is it that we are supposed to do what? To calculate depreciation. We are supposed to calculate depreciation. One, so here you can write somewhere. You can just note somewhere objectives of providing depreciation. Objectives of calculating or providing depreciation. One, we have to ascertain the true value of assets. To ascertain the true value. One, to ascertain the true value. Yes, the true value of assets and financial position. The moment we ascertain the true value of the assets, at the end of the year, the way you have seen, we can say now, after 5 years, this asset can cost this. Now we can able to do what? Come up with the financial position. So to ascertain the true value of assets and financial position. Then another one, to make provision for replacement of worn out assets. To make provision of worn out assets, so that we can do the acquisition. We can dispose those ones and be able to do what? To replace the other one, replace with the one that have been worn out. Then to calculate the correct amount of profits and loss. To calculate the correct amount of profit, calculate correct amount of profit and loss. Because I've said at the end of the year, we have to come up with the financial position or the balance sheet. So we have to come up also with the income, comprehensive income of the business to be able to determine the profit or loss. So depreciation, you'll also see how we treat it in that area. Then to compute the cost of production is another objective. To compute the cost of production. Good. Compute the cost of production is another key part in calculating depreciation. Then another one we have said it is a legal provision. Comply with the legal provision. Even the accounting standards or the accounting principles requires to calculate depreciation. So here is comply with legal provision. Comply with the legal provision. Comply with the legal provision. Good. So that is it in regards to depreciation. Just a small or very easy that way. So in the next video, if you are new to the channel, as I've said, remember to subscribe so that when we are coming to calculate now to see how we are going to, as an accountant, how you can account for depreciation. Because in the next video, we are coming to come up with the planned account. You're able to come up with the planned account. After planned account, we calculate depreciation. We calculate depreciation also, and also be able to come up with the provision of depreciation account and be able to extract the balance sheet. So that is the next part, carries almost for the 20 marks for those who are the students. But for those who are in the farms, this one is also a very important session for us. And even for those who own the assets, they say the vehicles and all that, you can now calculate for your vehicle. The moment you know the cost, and then the estimated value of that you expect to sell the vehicle after maybe certain period you have estimated, you can be able to know the depreciation after that period you have quoted. So for today, I'll say bye-bye. May God bless you wherever you are as we continue our learning together. Bye.